Everyone tells us to hold bonds as part of our investment portfolio to hedge against a falling stock market. And last year, the S&P 500 was down 20%. So thank God we had bond funds like BND to protect our portfolios against a drop like that. Oh, BND was down 15% last year? Okay. Well, what about ticker symbol EDV? That's a bond index fund that only holds US Treasury bonds with 20 and 30-year maturities. It doesn't get safer than that. So how did that one do? Down 39%? What the f***? Are we being lied to about bonds? Why are my bond funds down? How come they're not protecting us from the stock market like we were promised? Okay, there's gotta be an explanation here. Why don't you run off and go get me a drink, and I'll try to get to the bottom of why our bond funds are going down. Wait, before you go, can you at least tell the people to hit the like button and subscribe to the channel? No? Oh, real nice. Thanks. Okay, well, that guy was good looking, but he wasn't much help. So while he's gone, let's talk about why bond funds have been going down so much when they're supposed to be protecting our portfolios in times of stock market volatility like this. And there's really two factors at play in the reason why our bond funds are performing poorly: the interest rate risk and the duration of the bond fund that you're holding. You see, the prices of bonds fluctuate in response to market interest rate changes. And as we're all aware by now, the Fed has been aggressively hiking interest rates over the past year, from essentially 0 to a target above 5% in the coming year. And the duration of your bond fund or your bond ETF can be used as a measure of how sensitive that fund will be to changes in the interest rates. The duration of a bond fund is approximately the amount the price will fall for every 1% rise in interest rates. And you can see this play out with ticker symbol BND, which is Vanguard's Total Bond Market Index ETF. The bonds that the BND ETF hold give that ETF a duration of around 6 years. And the Fed rose interest rates by over 3% in 2022, which is why we saw the BND ETF fall about 18% before it recovered a little just before the end of the year. The reason this happens is because most of the return you can expect to get on your bond funds, or bonds in general, comes from the yield of that bond. And when new bonds being issued have much higher interest rates than the bonds you're currently holding, the value of those old bonds, the price someone's willing to pay for out there on the open market, obviously goes down. That's why something like ticker symbol SGOV, which is the iShares 0 to 3 month Treasury bill ETF, has a super short duration of about 5 weeks. And that ETF actually ended the year positive for the entire year. Because of its short duration, it wasn't affected as much by the rising interest rates. Because of its short duration, it kept up with each hike. So if I hold an ETF like BND or something with a longer duration, am I essentially screwed right now? And the good news is, no, you're not. Because the drop is only temporary. As these new issues with the higher yields get added to your fund or ETF, you'll actually come out ahead, provided you hold that fund or that ETF to the average maturity or the duration of that ETF. So if this is getting all confusing and now you're sitting there thinking, well, now I just don't know what bond fund, what bond ETF to buy or hold, here's how we can simplify that and answer the question of which bond funds you should be holding. Bonds serve 3 main purposes in a portfolio. They can provide income, diversification, or they can just be for preservation of your cash, your capital. And before you invest in a bond fund or a bond ETF, you need to decide which of those 3 is the most important to you for the bond portion of your portfolio. And for the average investor who's got a time frame of 5 years or more, a total bond market index fund that holds a variety of different bond types and a mix of durations is probably still your best bet. So don't be too down if you're holding something like BND from Vanguard or FBND, which is the equivalent from Fidelity. Those have hit a temporary bump in the road, but if you're in it for the long term and you're going to continue to hold, you'll gain on the other side when those are holding the higher interest rate bonds and interest rates have since fallen. Now, if you decide it's income that you're looking for out of your bonds, the highest yields and the best income you're going to get from bonds are going to come from things like corporate bonds and other types of bonds with slightly lower credit ratings. Something like US Treasury bonds will be the safest, most highly rated bonds on the bond market. those are going to carry a AAA rating. If you're looking for income out of your bonds, rating that generally provides the best combination of safety and return is going to be around BBB. However, these kinds of bonds will be more closely correlated with stocks, and because of their lower rating, they're going to carry higher risk than most other bonds you might typically invest in. That's why a lot of people tend to focus on getting their income from things like dividend stocks and dividend ETFs and taking the risk on that side of the portfolio and keeping the bond side of their portfolio only for safety and diversification. And for pure diversification purposes, your best bet is going to be long-term treasury bonds. Those 20 to 30 year maturity US treasuries will be the holdings that are most inversely correlated with the stock market. That means they're typically going to be the most unaffected by the stock market going up or down. Although, through periods of high inflation, like the one we're currently in, you will see these bonds decline right alongside the stock market, as we noticed with ticker symbol EDV earlier in this video. Now, if all you're worried about is preserving your capital, protecting your cash, short-term treasury bonds are going to be the best bonds for that purpose. Because short-term treasury bonds are short-term in their duration, they're going to be very resilient to changing interest rates because they simply mature quickly and aren't going to be needed to be held through a bunch of interest rate hikes or interest rate cuts. So you can either invest in short-term treasuries like something through ticker symbol SGOV, which is the ETF we already mentioned, or you can take more control over the bonds you buy and build a T-bill ladder for capital preservation, like I showed you how to do in this video right over here. So you go check that one out. I'm going to go try to find where that other guy went. And thanks for watching. I'll see you in the next one.